Hi, I'm Ben Finkelstein, Managing Director at Cantor Fitzgerald. I hold the Chartered Financial Analyst designation. I'm also the author of The Politics of Public Fund Investing. And I've had about 3 decades or more of experience in training and lecturing and developing training materials for public funds. And with that, I'd like to begin our session from policy to construction, portfolio structure, diversification, basically how to construct a suitable portfolio. So I'd like to follow in Albert Einstein's footsteps with this session. Everything should be made as simple as possible, but not simpler. So hopefully, while I will try to keep this at 30,000 feet, all right, there will be enough substance in here to give you a good foundation on how to construct that portfolio from an investment policy. So I'd like to begin with what is on the surface an innocent question: what do you manage? I know you think you understand what you thought I said, but I'm not sure you realize that what you heard is not what I meant. This was an excerpt from Alan Greenspan during one of his congressional hearings, and it captures perfectly the question. When I say, what do you manage? Most people begin to answer the question with bonds, risk, portfolio. What I'd like you to focus on today is that what you're really doing is you're managing expectations. The expectations of your stakeholders as it relates to the portfolio and its holdings. So our session overview is going to begin first with discussing some of the key challenges that you face when you attempt to link an investment policy to a portfolio and you're trying to construct from the policy. Next, we're going to introduce a framework for how to do this. How do you link your investment policy objectives to portfolio construction? And then we're going to look at the two most popular styles when it comes to managing a portfolio: book yield and total return. Look at how they're different because your construction process is going to be influenced based on which of these two styles you find yourself most adapted for. So beginning with linking the policy to the portfolio, an investment policy sets out objectives, risk constraints, your preferences, etc. It then is ideally going to merge those constraints and objectives with market conditions, opportunities out there in terms of what's available, the risk profile, etc. A thoughtful policy will always provide the situation where there's accountability, but most importantly, it will promote trust for your stakeholders. So the first challenge: how do we link a static document to a dynamic portfolio? So I want to digress for a second and just think about the challenge here. The investment policy is really just a Word document, or PDF these days, if you will. It's static. It rarely changes except on an annual basis when you go to review it. You can't mark to market the policy. You don't run cash flows on the policy. You don't shock the policy. All right. So how is it that this document that's so important in the process of portfolio management, how do you relate this static document to a portfolio that's always changing, that has not only the market influences, but unexpected influences? Could be lawsuits, could be what we're going through in COVID now with the concern about revenues and what's going to happen to businesses. So how to link a static to a dynamic portfolio is a challenge. And the way we do this is, first of all, think about the investment policy as your rule book. Just like in a football game, if you go in, you sit down, you kind of know the rules of the game. It's got a 100-yard field, it's 50 yards wide. It's going to take 4 downs to get to a first and 10. Touchdown is going to be 6 points. The policy is just that. It's a rule book. It's going to define what you're legally allowed to do, what you're legally permitted to purchase. It's going to specify the priority of the 3 policy objectives: safety, liquidity, and income. It basically says the following. This is right out of the GFOA sample investment policy under yield. It says the investment portfolio shall be designed, think of that as constructed, with the objective of attaining a market rate of return throughout budgetary and economic cycles, considering the investment constraints and liquidity needs. Now, what's important about this is that return on investment is of secondary importance compared to the safety and liquidity objectives described above. Now, this is directly out of the primer, which I would encourage each of you guys to download from CDIAC. This is a very important disclaimer. The investment policy in and of itself does not insure against any investment losses, nor does it guarantee good performance, something we'll be talking about a lot today. So return on investment is of secondary importance compared with safety and liquidity. Let's just look at this for a second and rank what we mean by that. I'd like you to take a second and write out how you would prioritize safety, liquidity relative to yield. All right, well, basically over the last, I'd say 3 decades of doing this informally, the majority of the participants that I've asked to survey come up with this relationship: 40% allocated to safety, 40% to liquidity, 20% to income. What basically is saying is we look at safety and liquidity as 4 times as important as we do income. Now, in fairness, there are other participants who have gone 90-10, 45-45-10, and there have been occasionally some that I think are are grandstanding where they go 25-25-50. I don't know how you would do that prioritization when the policy explicitly states safety and liquidity before income, but for full disclosure, there have been some participants that do say that. So with safety and liquidity 4 times as important as income, what do you think the most frequent question is asked about the portfolio? You guessed it. What's the return? Now, that brings up the whole issue of is investment practice following policy, and it segues into the second challenge, is that when you go to construct this portfolio from your policy, you not only have to construct it, but you also have to construct it in a manner that all of the policy objectives are benchmarked, not just return, and that the decision process, which is the third priority, is facilitated in the construction such that these decisions about safety and liquidity being more important than income can be described in the decision process. And we'll talk about that as we develop the steps to construct this portfolio. Again, focus on the investment policy is neither a guarantee against losses nor a guarantee of good performance. How is one to think about constructing the portfolio? Well, first, I want you to understand that simply constructing a portfolio solely based on the state guidelines is not enough. All right, it doesn't meet the test that we're going to establish today. Secondly, and often there's a misconstruction, a miscommunication of what you talk about when you use U.S. Treasuries as being full faith and credit risk-free. It is not a risk-free asset. There is risk even with the full faith and credit of the United States government. And so those 2 notions need to be modified to fit in the portfolio construction process. So newsflash, after constructing the portfolio that complies fully with the state code, the policy objectives, you will likely experience a recognized unrealized loss at some point during the budget and economic cycle. I don't know of any fixed income portfolio manager on the planet that can avoid a mark-to-market loss unless, as we will get into a little bit later in the session, you use a reporting standard to dominate your investment strategy. We'll get to that in a second. So the fourth challenge here, and a very important one, is to understand that constructing the portfolio is not about avoiding the loss. It's about determining how much of a loss is acceptable or suitable. The regulation I was referencing just a second ago was GASB 31, what I call the politics that are involved in constructing a portfolio. For those of you that are new and may not be that familiar with GASB 31, it's a fair market value requirement that forces local agency governments into showing unrealized losses or gains for any reporting period as if they were realized. All right. When constructing the portfolio using GASB 31, one of the unintended consequences of this reporting standard can be, doesn't mean it always is, an indirect pressure on the portfolio manager to build the portfolio around avoiding these mark-to-market losses, which typically ends up being in a much shorter maturity portfolio. So the critical consideration when you go to construct the portfolio is, first of all, how much are you going to allow a reporting standard to influence your investment strategy? Now, I'd like to ask a question. Does legal mean suitable? Would it be possible to construct an investment portfolio that complies with all the state code while avoiding GASB 31 mark-to-market losses? And one of the simple answers to that is yes, you could be 100% in cash. You know, there are other fixed income securities we'll talk about a little bit later that also meet this test that are not subject to mark-to-market. But as a portfolio manager and in the construction process, the question that you have to ask yourself is, constructing a portfolio basically of short-term securities, is that appropriate, or what's wrong with it if the sole purpose is just to avoid a loss? Well, concentration risk, you're putting all your liquidity eggs in one basket. It may be a risk pool, it may be just cash in itself. It lacks diversification. And at the end of the day, it is a significant income opportunity cost. None of these would, in the context of a professional portfolio management process, be considered good stewardship or consistent with good portfolio management. So simply having a legal portfolio, as you will hear me mention time and time again, does not mean it's suitable. And it's consistent with CDIAC's primer that says simply having the policies doesn't mean you're going to be guaranteed against having investment losses, or it's somehow good performance as a result. Now, to just quantify for you the opportunity cost of a short portfolio, I put together this table that looks at 3 different choices, comparing cash to a 1-year, 2-year, and 3-year CMT, which is the constant maturity treasury. What makes this unique is, unlike other benchmarks, it doesn't consider unrealized gains or losses. It looks at just the yield. And just using that middle scenario, scenario 2, I wanted to very conservatively look at the last 10 years and simply look at the opportunity cost of being in cash or cash equivalent, the 3-month treasury bill, 3-month treasury, constant maturity treasury, use that as the cash equivalent to, for instance, a 2-year treasury. I would say the lion's share of public funds look at the duration of their portfolios mostly in the context of a 2-year treasury. If you were to do this over the last 10 years, the difference in spread between the 3-month treasury, constant maturity treasury, cash proxy, and the 2-year treasury is about 33 basis points. Or on $100 million of investment, about $330,000 a year, $3.3 million over the last 10 years. It's a significant hit. I'm being quite conservative. If I went back longer, you would see those spreads would be wider and greater. Another way of looking at it when we talk about this with councils or stakeholders is, how much would you have to increase the portfolio size to offset that $330,000 of revenue lost because you're trying to stay under that quote unquote 12-month window to avoid losses? You would, at 50 basis points in this scenario, have to increase that portfolio by 66% or $66 million. So it would take $166 million at 50 basis points to replace the $100 million invested in the 2-year constant maturity treasury. The key takeaway here is not to get in all the weeds here, but to understand that there's a real cost to letting a reporting standard influence the construction process, and not recognize that as a steward of a public entity, you're there to manage risk, not to eliminate it. So does safe mean liquid? We have safety, liquidity, and income. Is it possible for a public fund to fail if a portfolio was constructed using all AAA rated securities, had no issuer's default, and all the holdings within the portfolio complied with the California State Code? Well, as you guys might know, yes, it's possible. Orange County, California in '94 declared bankruptcy, and it met all of these tests. All of their holdings were basically AAA rated. There were no issuer's default. The question that you have to ask is, how could some entity fail if they're in compliance and there are no issuer defaults. And that's the difference between understanding a legal portfolio versus a suitable portfolio. One of the examples of being legal and not suitable we'll talk about is that one where you're all in cash. You know, you could legally hold 5-year treasuries, 100% of them, and be legal. Would it in fact be suitable? Likely not. So when you go to construct the portfolio, particularly in this scenario, one of the biggest hurdles to overcome is understanding how these policy objectives and what roles they play in the construction process, and which of these three, safety, liquidity, and income, pose the greatest threat to principal preservation. Most, when they begin to construct a portfolio, think it's safety. I'm here to suggest to you that it's really liquidity. Had Orange County had the liquidity to withstand the market move, they would not have had to file bankruptcy. They would not have had the loss. It had nothing to do with the safety objective. There were no defaults. It had everything to do, they did not have adequate liquidity or prepare for that in the construction process, such that they were forced to liquidate at a very bad time in the marketplace. Back in '94, the Fed was raising interest rates. They were over-concentrated. They had a mismatch of their liabilities or their duration. Long story short, they did not understand liquidity is likely the greatest threat to a public funds portfolio, and one of the most important considerations when constructing a portfolio from the investment policy objectives. So I'm a visual guy. I think one of the ways to kind of get an understanding of how you construct the portfolio is to have a visual framework. So here we're looking at the link between your investment policy and a portfolio. And you notice if here over to the right, it says plan. That add, if you will, that change is to create an investment plan to provide the bridge between the investment policy and the investment portfolio. So recall, the investment policy is your rule book. It just simply sets forth what's legal. What it doesn't do is provide you the playbook. So going back to our football analogy, you're sitting in the stands, but the quarterback, the portfolio manager on the field, looking at second down and 6, 2 minutes left on the clock, knowing the rules of football isn't going to help him run his next play. He needs a playbook. He needs something that he can go by that will basically allow him to run his next play. And that's where the investment plan comes in. The investment plan, think of it as an investment policy converted to a portfolio that reflects your cash strategy, your objectives, how much liquidity do you need. Think of it as your risk tolerance. It's going to describe in advance how much interest rate risk or credit risk you're going to allow for. It's going to describe the sector allocation, how much you're going to provide. Are you going to follow the state code and allow for 30% in corporates? It's going to govern what the actual portfolio manager does and basically move that static link to a dynamic one. So you see here from the investment plan, it serves as a blueprint that guides the portfolio construction so that the portfolio manager now has a context, a dynamic one, that allows them to make investment decisions that incorporate not only the market conditions, but also the unexpected conditions that could arise from politics, lawsuits, etc. The plan, in essence, provides accountability between policy and portfolio. At the end of the day, the investment plan serves as a suitability benchmark for merging the investment policy objectives set forth in your policy with your local agency's risk-reward preferences. So what are some of the considerations that you have to have before constructing? The first is standard of care. What is the standard of care going to be or applied when you're constructing the portfolio? Next is going to be the benchmark. What performance are you going to use to evaluate how you're doing? The next is measurement. How will performance be measured? And then last but certainly not least, what are some of the basic steps that we must follow when we go to construct this portfolio using the investment policy portfolio idea. So the standard of care is straightforward. It's prudence. And typically, I think under California now, it's the prudent investor standard that's going to be used and applied at the overall portfolio level. But there are still many that use the prudent person standard, and it states the following: investment shall be made with judgment and care under circumstances then prevailing, which persons of prudence, discretion, and intelligence exercise in the management of their own affairs, not for speculation, but for investment. Importantly, considering the probable safety of their capital, as well as the probable income to be derived. That's really the standard that's going to govern it. Now, look at that standard for a second and you realize, A, there's no market timing here. It's not for speculation. You're investing, and you're investing in the current market conditions. You don't know what the future holds, so you're not to speculate, and that you're to consider the safety of capital, but at the same time, you're also to consider the probable income that you can derive from investing. So that's where it's not an either or statement. It's not investment, safety, liquidity, or income. It's all three. That's the requirement that you need to understand when it goes into constructing a portfolio. If you do these things, this just simply says that you have no liability. If you follow the guidelines, you follow your written policies, you're timely in reporting issues like a downgrade, et cetera, and you follow the procedures, you'll have no personal liability as a result. So benchmark. In constructing the investment portfolio, it's important to understand the distinction between performance evaluation and performance measurement. These two get interchanged frequently and they get treated as the same, but they're quite different. Let's begin with understanding just what exactly is the benchmark that we're attempting to evaluate. Well, it's your stewardship. Just as I mentioned when we were talking about what do you manage, when I say you manage expectations, it's really you're being requested at the end of the day, all of this benchmarking and stuff that Wall Street wants to dazzle you with and compare this benchmark to that benchmark. At the end of the day, what the answer to the question that they're trying to find out is, are you a good steward? And what does that stewardship mean? It means that you have struck a suitable balance between preserving principal, having adequate liquidity to pay your obligations without having to sell a security before maturity, and that you're earning a reasonable, responsible rate of return. All three of those. And while safety and liquidity at times may be diametrically opposed, I mean, how on the one hand do you preserve and protect while on the other hand generate income? They are in concert with one another. And all of this benchmarking, all of the effort on the part of Wall Street and everything is designed to do one thing. Are you a good steward of the public's funds? Have you struck that right balance? Which brings up the challenge of performance measure. What metric are you going to choose to measure stewardship? I mean, most people quantify a benchmark, whether it's the Merrill Lynch, BAML, ICE, 1 to 3, 1 to 5, they quantify that. But when we start talking about stewardship, that becomes a little more squishy. How are we going to choose a measure, all right, that can quantify, are you a good steward? Well, the measure for that is suitability. Suitability, i.e. the suitability benchmark or the investment policy portfolio, moves the idea from a rule book to a playbook. It tells all the stakeholders in advance what your portfolio should look like through time. Now, to construct that portfolio, that dynamic portfolio, that investment plan, there are basically 5 criteria that go into construction that you have to be aware of. All right. The first and foremost is, do you have adequate liquidity? Because one of the questions is, how do I quantify stewardship if I use suitability? Well, what are the steps or the quantifiable parts of suitability that I can use to evaluate whether I'm a good steward. And that first criteria, that first step is, do you have adequate liquidity to pay obligations without relying on a security to be sold? That's the first step. The second step is, again, you're not trying to avoid risk. How much risk am I willing to tolerate to generate a reasonable return for my entity? And that's going to be dependent on each and every public entity. It's not going to be the same for every, and usually that primary risk is how much are we willing to allow the portfolio's mark-to-market value to vary when interest rates change. Concept called duration. It'll be covered, I'm sure, in upcoming sessions, in the benchmark sessions, all right? But that's the second most important consideration in constructing the portfolio. What we don't have time for today is looking at how do we arrive at liquidity? How much is enough? What due diligence did we go through to produce the liquidity level we find acceptable? How much interest rate risk did we take? What did we use to determine what was acceptable? Next is the allocation. At the end of the day, I simply say you should be the state code. State code allows 30% in MTNs. It allows an unlimited amount in GSEs, callables, etc. You have to determine for yourself and for your entity what that allocation should be. That's the third step. The fourth step is to establish an appropriate market rate of return. And I want to emphasize appropriate market rate of return. When we first began this back in the early 90s, before the investment policy was the mainstay that it is today, that language, market rate of return, is not an accident. What was recognized, and I credit the MTA before it became the APT, in their language, began to recognize that they wanted individual entities to be able to select their own market rate of return. They realized that there wasn't a silver bullet that fit all public funds. A very important thing to understand when constructing a public fund portfolio that gets lost in translation oftentimes, particularly when you see these surveys come out and they ask you, what do you hold and what's your return on your portfolio? And the comparison, I won't say exactly who it was, but one of the big cities were comparing their returns to other cities, as if that has some relevance in the construction process for other entities. While public funds, and please understand what I'm going to say to you, while public funds share the same state code, they're under the same guidelines, and while they share, for the most part, the same investment policy objectives of safety, liquidity, and income, all right, they do not share the same risk tolerances. They don't have the same economies. They don't have the same expertise. They don't have the same portfolio size. So it's incredibly important to understand that there is no one silver bullet benchmark for all public funds. And that when you go to understand that really the only benchmark that a public fund can rely on is its investment policy. When Orange County failed, they didn't go to the Lehman Ag and ask how he performed against the Lehman Ag. Back then, that was the index, or the 1 to 5. They went to his investment policy. The problem and the lessons to take away from that was the policy started with what was legal, but it didn't get to that suitability part of it. All right, the investment plan, the investment policy portfolio, describing how much liquidity is suitable, how much interest rate risk is suitable, what our allocation should be, what our market rate of return should be. As an example, most governments, not every, either use an index like the ICE 1 to 5 or 1 to 3. Others are using the 12-month moving average of the 2-year constant maturity yield because they don't book paper gains and losses. The point about this is that the market rate of return is defined for your entity. It may be 18-month, the interpolation between the 1-year CMT and the 2-year CMT. It doesn't mean you are just to adapt what Wall Street has. It means you are to first and foremost determine what your liquidity needs are, what your risk tolerances are, what your comfort zone is with the allocation, and then determine based on that what the return of the index you're going to use. Most governments pick the 2-year treasury because that's if you're investing, that's typically at a total portfolio level, what you should earn for the most part. There are exceptions. We can go into that on Friday at the session where they are able to answer questions for the participants in the session. So this kind of dovetails into a question that is often overlooked, if not, it's not even considered, and that is, why is yield a policy objective at all? I mean, why is it included there? If it wasn't important, why is it there? Well, as the prudent standard pointed out, prudent person standard, not for speculation, but for investment, considering the probable safety of capital as well as the probable income to be derived. What are they getting at there? What is it that they're trying to communicate in the construction, attaining a market rate of return through budgetary and economic cycles? What are they trying to capture here? Well, I think they're trying to capture the following. Increased earnings from the taxpayer dollars in a portfolio means more public services, fewer layoffs. If you go back to the Great Recession, income can help provide for the income necessary to not lay people off. It can provide for additional services. It can pay for the very government that it's paying taxes to, the salaries, et cetera. So when you think about the yield as investment policy objective, what it's really doing at the end of the day is it's making the taxpayer's money work for the taxpayer. Every dollar that that portfolio earns is a dollar that the taxpayer doesn't have to fund. And that's why yield as a policy objective is included, in my view, my humble opinion, in the investment policy, and why it's so important not to minimize its importance or relegate it to simply being this third objective that no one cares about. Philosophy, what's the philosophy of public funds? Just follow the prudence. You have a responsibility of stewardship over the public money that's been entrusted to you to manage it. Well, that philosophy has a purpose, and that purpose is that the portfolio's got to be constructed first and foremost to preserve principal, second to ensure that you can pay bills on a timely basis, and that you can earn a responsible rate of return on the money. Now, we've talked about the construction process. What are we trying to evaluate? We're trying to evaluate your stewardship. All right, how are we going to do that? We're going to look at creating an investment plan, a strategy, a suitability that moves it from a written document into a live portfolio policy statement, right? That shows specifically the 4 criteria: adequate liquidity, appropriate interest rate risk. All right, you have the appropriate allocation and a market rate of return. Before we get into these two styles, to give you an example of what I'm talking about, let's say through your due diligence, and we can talk at another time about how that due diligence is done. Let's say that the policy portfolio, your investment plan, established 20% as the operating liquidity that you needed to have on hand at all times. And let me give you 2 scenarios where it's not 20%. So when you go to report one month, it's 30%. And one of your council members asks, well, wait a minute, the plan calls for 20. Why are you at 30? All right, well, there could be several questions or several answers to that. 2 of which would be, it could be December and we've got all our tax money in and we haven't deployed that liquidity yet. The second one, which happens frequently as well, is that we're building a new police station, fire station, or we're doing some infrastructure and we need additional liquidity, all right, to make sure we can meet those construction draws. Another important point of the suitability benchmark, the investment plan, is not that the portfolio will always perfectly align with the policy plan through time. What it basically is saying is that you can explain why they're different, because the portfolio is going to change through seasonal demands, up and down. It's going to change through economic cycles. So you need a framework for how to look at what happened, why it happened, and is it consistent with what we're doing? So we go back to, are you a good steward? An example of if it's 10%, all right, why would it be below the 20%? And that could be, it's in June, July. We've been spending more than we've been making, all right, or that we had an unexpected payment and we're going to replenish that when the tax revenues come back in. So we won't be investing. The point is that the investment plan, the suitability benchmark, provides a dynamic way of staying consistent with your investment policy guidelines of placing safety first, liquidity second, and income third. So from a policy directive, it's safety, liquidity, and income. But importantly, when you go to construct this portfolio, it's liquidity, income, and safety, because safety for the most part is a non-event. Doesn't mean it doesn't have issues. We can go back to 2008, but for the most part, it's interest rate risk and having adequate liquidity to pay your bills that's going to be the greatest threat to constructing the portfolio or that objective of preservation of principal. Now, as I promised, the two popular portfolio management styles are book yield and total return. How are they different? Well, let's begin first with book yield. Yield is defined as the income return on the investment. This is right out of Investopedia. Think of it as the cash flow that's being thrown off of the bond or the portfolio with no invasion of principal. Investors focusing solely on yield typically look at to preserve principal and allow the principal to generate income. You know, these are not my words, these are Bloomberg. I'd like to edit it, but it says a group of securities designed to provide high short-term income as opposed to long-term growth. I'd probably drop that adjective high and just leave it at short-term. But it says an income portfolio is just what it says, fixed income. It's there to produce income, all right? Whereas when you look at total return will include both the income or the coupon, but it will also look at the capital appreciation, that paper gain or loss, as being important to the process. It will focus on growth. You see total return used most frequently on Wall Street, in the equity markets, active managers, etc. While total return investors do not want to see their overall portfolio value diminish, preservation of capital is not their main investment objective. A growth portfolio, again, should kind of give you an idea that growth as being used in this context of portfolio management, I think is misplaced. Growth in the Bloomberg is used as comprised of stocks that are expected to increase quickly in price, to be an inflation hedge. There is absolutely nothing. I don't know how anyone can look anybody in the eye and say the fixed income portfolio is growing when the return on the portfolio as a percent is likely not to keep anywhere near the pace of salary increases, the cost of government, medical, etc., which is the idea of purchasing power parity, keeping things at least at a dollar to dollar means. When they say grow the portfolio, which is a term I have issues with, it is you're not taking the money and spending it for the budget. You're just keeping it and reinvesting it, and somehow or another the portfolio grows. But if you looked at that in the context of you know, inflation as it relates to a government, you know, you should be spending every nickel to pay down whatever you could, because the rate of return on your fixed income portfolio is not going to keep pace with the inflation inside government. Personal opinion. All right, so total return, as I mentioned, is kind of indifferent. It looks at total, you know, at paper gains and losses as being real. So it measures the increase of the investor's wealth due to both investment income and capital gains. The total rate of return implies that this dollar of wealth that's generated is equally meaningful to the investor, whether it's generated from a 90-day T-bill or from the price appreciation of a stock. All right, the takeaway from this is that the gain or loss is equally important as the coupon income. And for many where budgets are important, that's where these styles, I think, vary. If you are, and we'll summarize it here in a second, if you're focused on budgets, I think book yield is probably more relevant. If you don't use paper gains and losses and you don't need the funds for budgeting, total return is going to be a more relevant process. So what is book income? In the prudent person standard, it's focused on cash flow. It's money committed to the budget. When you think about total return growth, it's basically money that's saved and reinvested to grow the investment portfolio. The earnings are not being used for the budget purposes. So the key distinction here is that total return is usually with portfolios that don't need the funds for budget purposes, whereas book yield is used when you're constructing the portfolio. Again, you would have two different thought processes as far as liquidity goes. on being able to build a portfolio around a book yield versus total return, where transaction cost is quite high in turnover. If you're active, you'd want to minimize that. If you're not active or you're passive, it would be less relevant, and you'd be looking at more of an income to maturity. Here, think of it as passive. The investor passively takes advantage of market and structure premiums, since it doesn't intend to sell the security before maturity to profit from the price movement of the bond. Its focus is on yield. All right, it doesn't care that the bid and offer spread is slightly wider than it would be on a bullet or a treasury. It looks to take advantage of those risk premiums. The active or the trader, on the other hand, is going to invest in the bond, and its intention is to sell before maturity. So what do we mean by book yield? The strategy is to produce stable income throughout the budgetary process, minimizing the need to rebalance in the middle of the year. So for instance, when you go to construct this portfolio and budget plays a role, you want to construct a portfolio with a duration at least as long as the budget cycle, all right, probably 12 months plus 6 months, so around 18 months, so that should markets change, interest rates go up, interest rates go down, the cash flow from the portfolio has minimum volatility given those small moves in interest rates throughout the budget cycle. Obviously, you can't plan for a 150 basis point move one way or another within a 12-month cycle. Next is the total return. Active, this is structured to beat the market. They're trying to basically either use superior security selection, finding securities that are cheap relative to their peers, or sector allocation. I'm going to be weighted in treasuries when I think agency spreads are going to be wide. I'm going to be in corporates when I think corporate spreads are going to narrow versus agencies. They would sell a bond at a loss in anticipation that on a total return basis, they would be better off because of spread. It's a much more sophisticated strategy. It's one used primarily by the bigger funds, entities, public entities. There we go. Now, just again, to reemphasize the distinction between total return and book yield, and in construction process, you're going to have a different look in a portfolio constructed around a budget than you are around total return. If you look at that middle line, the green circle, that is the income on a 5-year treasury, 2% coupon bought at par. That income is going to be the same regardless of the mark-to-market value of the portfolio. So you budget 2% for 5 years, there's very little uncertainty around that cash flow, all right, as it relates to changes in interest rates. And you can see as we move instantaneously in the beginning at 0, if interest rates went up 100 basis points, the value on that 5-year treasury would have dropped below 96, and you'd have all north of a 4-point loss, but the cash flow remains unchanged, the budget remains unchanged. So again, for those government entities that don't budget paper gains and losses and understand that you're buying whole for the most part, doesn't mean you're not going to pay attention to market conditions and adjust accordingly. It just means that for budgeting purposes, you're not looking at the paper gains and losses as a strategy to buy or sell a security. So book yield excludes the paper gains and losses. It's structured to take advantage of higher income. So as an example, it'll prefer, at times, and by the way, this is not saying all is better than the other. When I say callable versus bullet, I'm not suggesting that you should have a portfolio of all callable bonds. What it's simply saying is you diversify, you can add callables because they're going to yield more in an unchanged rate environment, in a rate environment where rates might go up. They're going to underperform, obviously, if rates rally. So you have to balance this, but on the surface, all right, you can take advantage of the yield premium of an agency versus a treasury. You can take advantage of a discount note versus a T-bill, of an MTN, a corporate bond versus an agency. Book yield uses that kind of strategy in constructing the portfolio. When you're dealing with an active total return portfolio that includes paper gains or losses, and that will be actively buying and selling the portfolio or bonds within it, that spread, that bid offer spread matters. And the book yield, if you will, plays less of a role of contribution to the return than the gain and loss, the paper gain and loss. So book yield or total return, conclusion, they're really just a different kind of saying. From a prudent standpoint, constructing a portfolio to achieve a market rate of return throughout budgetary and economic cycles, taking into consideration the probable safety of capital as well as the probable income to be derived, likely favors a book yield approach. Local agencies who choose not to focus on reinvestment proceeds, not to focus on budgets, but focus on the reinvestment of those proceeds back into the portfolio, will likely favor total return. It's not one is better than the other. It's really what is your entity focused on. So in summary, linking the policy to the portfolio, an investment plan, a suitability benchmark, an investment portfolio, a policy portfolio provides your stakeholders with a way to compare the investment policy objectives with the actual portfolio constructed. Just as the investment policy sets out what's legal, the investment plan provides the specific performance measures that help your stakeholders monitor the investment portfolio's suitability. Last but not least, GASB 31 is a reporting standard, not an investment strategy. Be careful. Public fund professionals should be careful to avoid reporting a regulation that allows it to unduly influence its investment strategy and decision making. And as Will Rogers said, it's not the return on my investment that I'm most concerned about, it's the return of my investment. I want to thank all the participants for participating today. The next session, Agency Profile, on the day-to-day management of public funds is going to get a little more broader take on the portfolio management side of this. Also would like to offer a complimentary copy of my book, The Politics of Public Fund Investing. If the participants, if any of you are interested in getting a copy, if you'll just reach out, we'll make sure that you get a copy. Thank you again.